Sebring looks like the answer retirees have been searching for. Quiet streets, inland Florida, home prices that still look stuck in the past. No beaches, no tourists, no coastal storms, at least on paper. But cheap towns don't stay cheap by accident. They stay cheap because something is missing. In Sebring, affordability didn't come from smart planning, it came from stagnation. And now, as insurance costs rise and Florida's population shifts again, Sebring is quietly becoming one of the most misunderstood retirement bets in America.
Florida's second migration wave. Florida's first migration wave chased beaches and big metros. The second wave is different. Rising insurance costs, congestion, and taxes pushed retirees inland. Places like Sebring absorbed people who were priced out, not drawn in. During the 2020 to 2025 housing surge, investors skipped Sebring, builders skipped Sebring, job growth skipped Sebring. Prices rose modestly, not explosively, and that stability now masks a deeper vulnerability.
Sebring. Why people move here? Median home prices far below coastal Florida. No hurricane evacuation zones. Quiet, low-density living. Appealing to retirees on fixed income. The trade-offs few discuss. 1. Housing isn't crashing, it's aging. Sebring didn't overbuild. Most housing stock is decades old. Cheap prices often mean deferred maintenance, roofs near end of life, electrical and plumbing upgrades required. Insurance companies see this clearly. Buyers often don't. 2. Insurance isn't cheap here anymore. Sebring avoided coastal flood premiums, but statewide risk pricing caught up anyway. Older roofs, older wiring, and higher replacement costs mean inland Florida is no longer immune. For retirees, Sebring looks affordable. In daily life, the margin is thin. Home prices stay low, but resale liquidity is weak. Medical access is limited compared to Metro Florida. Insurance and repairs eat fixed incomes. Younger households leave, retirees cycle through. This creates a closed loop. Low prices attract retirees, but low opportunity prevents renewal. At first glance, Bartow, Florida looks like a solution. Affordable homes, quiet neighborhoods, no bidding wars. In 2025, this is the kind of place Americans are told to move to. But something here doesn't add up. Homes are cheaper, yet monthly costs are rising. Rents are flattening, even as new listings pile up. And the people arriving aren't staying as long as expected. Bartow isn't crashing. It's doing something more dangerous. It's becoming quietly unaffordable after the purchase. Across the U.S., the housing crisis isn't uniform anymore. Major cities are freezing, boom towns are stalling, and smaller inland cities are absorbing the fallout. Florida saw record migration after 2020. By 2025, that surge slowed. Interest rates stayed high, insurance costs exploded. For fixed-income buyers and retirees, the math no longer works the way it used to. Bartow sits inland in Polk County, away from the coast, hurricanes, and hype. That's the draw. Home prices remain well below Tampa and Orlando. Property taxes are manageable. Crime is lower than nearby metros. But affordability here comes with hidden exposure. Pros: lower entry home prices, quiet lifestyle appealing to retirees, less competition from investors. Cons: home insurance rising faster than home values, aging housing stock with deferred maintenance, limited healthcare infrastructure, weak local job market if remote work fades. Listings in Bartow are sitting longer than they did 2 years ago. Rent growth has stalled. For retirees, that means limited equity growth. For landlords, thinner margins. For sellers, slower exits. When demand weakens in small cities, there's no surge to restart it. Looking toward 2026, the risk isn't a crash, it's stagnation. If insurance costs keep climbing, If migration slows further, if fixed-income buyers pull back, Bartow risks becoming an affordability trap. Cheap to buy, expensive to hold, and slow to leave. Bartow isn't broken. It's a warning. In today's housing market, the lowest price rarely shows the full cost. And in 2026, what's hidden matters more than what's listed. Ocala, Florida looks like a retirement dream. New homes, gated communities, prices that still look reasonable. In 2025, people are moving here for one reason. It feels safer than coastal Florida and cheaper than the cities. But something beneath Ocala's growth doesn't add up. Homes are being built faster than jobs. Rents are losing momentum. Insurance costs are quietly rewriting monthly budgets. Ocala isn't overheating, it's stretching. And stretched markets don't snap all at once. They sag slowly until nobody wants to admit it. Across the U.S., the housing crisis has changed shape. This isn't a 2008-style collapse. It's a slow affordability squeeze. High interest rates, rising insurance, flattening wages. Florida absorbed millions of new residents after 2020. By 2026, that wave slowed. What remained were inland cities like Ocala, carrying growth momentum built on retirees and equity-rich movers. But momentum fades when costs keep climbing. Ocala sits in Marion County, far from storm surge and beachfront premiums. That's the pitch. Home prices remain below major metros. New construction is everywhere. Master-planned communities promise predictability and peace. But Ocala's affordability rests on fragile assumptions. Pros: lower home prices than Tampa, Orlando, or South Florida. Large supply of new housing, popular with retirees and snowbirds. Inland location reduces hurricane exposure. Cons: insurance premiums rising even without coastal risk. Infrastructure lagging behind population growth. Limited hospital capacity relative to retiree inflow. Weak job diversity outside healthcare and services. Overbuilding risk if migration slows. Ocala isn't short on houses, it's short on economic buffers. By 2025, listings in Ocala are taking longer to sell. Rent growth has slowed compared to prior years. For retirees, this means home values may stall while ownership costs rise. For investors, returns are thinning. For locals, competition from new builds pressures resale pricing. When supply outpaces demand, prices don't crash, they drift. Looking toward 2026, Ocala's risk isn't collapse, it's imbalance. If insurance keeps climbing, if retiree migration slows, if builders keep adding supply, Ocala could face prolonged stagnation. Too expensive for locals, not rewarding enough for newcomers. Ocala isn't a failure, it's a test case, a reminder that in today's housing market, growth without balance creates silent risk. And in 2026, the most affordable cities aren't always the safest ones to bet on.
Jacksonville was supposed to be Florida's safe bet. No Miami prices, no Tampa chaos, no Orlando tourists. Just affordable homes, low taxes, warm weather, and a quiet promise to retirees and remote workers. But something changed. Insurance bills quietly doubled, rents stopped falling, and then snapped back. Entire neighborhoods became impossible to insure. Jacksonville didn't crash loudly, it's unraveling quietly. And for people who moved here believing they found Florida's last affordable city, the math is no longer working. After 2020, Florida absorbed one of the largest migration waves in U.S. history. Retirees fled high-tax states. Remote workers chased affordability. Jacksonville became a pressure valve. Home prices surged over 50% in just a few years. Investors followed retirees. Builders chased demand, but not infrastructure. Now, as rates stay high and insurance markets fracture, Jacksonville is facing a problem common to second-tier boom cities. It grew faster than it could stabilize.
Jacksonville. Why people moved here? Median home prices stayed below South Florida. Large metro footprint with suburban options. No state income tax. Perceived lower climate risk than coastal Florida. What they didn't see. Number 1, insurance shock. Home insurance premiums in parts of Duval County have doubled or tripled since 2022. Flood zones expanded quietly. Private insurers pulled back. Citizens' insurance waitlists grew. Number 2, rent illusion. Rents softened briefly in 2024, but investor-owned inventory is tightening again. Many cheap rentals are older homes with rising maintenance and insurance pass-through costs. Number 3, infrastructure gap.
For 5 years, Tampa was one of America's hottest housing markets. Homes sold in days. Rents surged. New residents arrived faster than the city could absorb them. In 2026, the story sounds different. Listings are sitting. Rent cuts are quietly returning. Insurance bills are reshaping monthly budgets overnight. People aren't fleeing Tampa in panic. They're leaving in phases. And when a boom city cools, it doesn't cool evenly. It fractures. The U.S. housing crisis in 2025 isn't about sudden collapse. It's about affordability breaking in layers. High interest rates locked buyers out. Insurance costs surged nationwide. Remote work slowed, then reversed. Florida felt this shift first. Migration cooled. Speculation retreated. And large Sunbelt cities like Tampa began absorbing stress instead of growth. Tampa sits at the center of Florida's urban experiment. Strong job growth, waterfront appeal, and years of relentless housing demand. But Tampa's affordability model was built on momentum, and momentum is fading. Pros: diverse economy compared to smaller Florida cities, waterfront lifestyle and cultural growth, large rental market with turnover, major healthcare and logistics employers. Cons: home prices still elevated relative to local wages, insurance premiums rising fastest near the coast, condo exposure to HOA and assessment shocks, infrastructure strain from rapid population growth, rent softening in oversupplied neighborhoods. Tampa isn't running out of demand, it's running into limits.